Yes.
Can you hear me?
Yes,
Okay.
now you're good.
All right. Good morning, everybody. My name is Oshrat Carmiel. I'm a real estate reporter with Bloomberg News. Thank you, everybody, for joining. This is a webinar hosted by the Riverside Experience, a division of Riverside Abstract, one of New York's largest title agencies, as well as a qualified 1031 exchange intermediary. Our sponsor today is Click AI. Please take a minute to watch a short video demonstration of their automated modeling software.
Welcome to Click AI's product demonstration. After logging in, you can create a new project by specifying asset type and template from the drop-down menu. When I click on the project, I'm shown the project view. Here I can upload or drag and drop files associated with the asset type, including rent rolls, historicals, and trailing 12 operating statements. Next, I need to tag each of these files by mentioning the document type and dates or period it is valid for. I do the same for the rent roll. Next, I hit refresh to ensure that the documents have been processed, symbolized by the green sign. Click AI utilizes AI to prepare the final document. As you can see, for the rent roll, I can view the source data sheet and see if the tenant information has been extracted in my target data sheet. I can choose to download the spreadsheet. Similarly, I can view and even edit my trailing 12 document right from the browser. Here I can change one line item's category easily. I can go ahead and download this as well.
Good morning. Thank you very much for that. And I am going to introduce our panel. We have here Patrick Carroll. He is the CEO and founder of Carroll. It's a real estate investment company with $5.2 billion in assets under management and 30,000 multifamily units under management across the country. We have Norman Radow, founded the Radco companies more than 25 years ago. He became an expert in loan workouts during the last recession, helped advise Lehman Brothers estate in bankruptcy. And in the most recent real estate cycle, they acquired and repositioned more than 28,000 Class B apartments, sold most of the portfolio over the last 2 years, but Radco currently owns and operates 12,000 units across 7 US states. And Stephen Rosenberg, founder and CEO of Greystone, a private commercial real estate finance and investment company in New York. Greystone is a top HUD, Fannie Mae, and Freddie Mac lender with $14 billion in originations last year. Currently, it manages a $60 billion loan servicing portfolio. So we have a wide breadth of experience and knowledge to talk about today. So I'm gonna start with a bit of news, and this one, feel free to jump in. So on Friday, the National Multifamily Housing Council released its figures for its most recent rent tracker, and it showed that as of May 6th, 80% of renter households made a full or partial rent payment, and that's despite more than 20 million people losing their jobs in April. So let me start with you, Pat. What do you see when you look at those numbers in this context?
What do I see? I see the best thing I've ever seen. I mean, I think we all expected it to be much worse. So, I think it's very consistent with what we saw in April. I just checked our numbers before the call. We're at 90% collected so far for May. So what I see is hopefully, people prioritizing the rent payments, which I think we collectively thought they would. But people are paying their rents for the most part, even in at a broad area across the country. It seems like consistently rent collections have come in pretty strong.
Norm, you have anything to add to that? Are you seeing that reflected in your portfolio?
Well, as I
have had to say too often in the last 8 weeks, anything I say forward thinking is probably wrong. And if it's right, it's by accident. So I would not have predicted this. We were prepared for a 20% reduction in revenue. We saw about 6% reduction in April. May is actually trending a little better. Obviously, we don't know how the end of the month will be, but right now we're about 87, 88% collected, about 3% higher than this period last month. I will point out, though, and Pat and I both from Atlanta and our headquarters here, that Georgia has the highest unemployment in the nation. Right now, it looks about 28% or so, and it's overwhelming the Labor Department. Florida is very similar, and they can't get claims processed. So right now, I think they're about 6 weeks behind on their claims, and I think this is going to have a major impact on what happens at the end of this month and into June. Is that stimulus going to be there? Are they going to actually pay it or not, and how much? And I think that will dictate a lot of what happens in June. But as Pat mentioned, there's no consequence for not paying rent. You can't evict anyone now in our markets, nor can you charge late fees. So while the revenue may be, the percent of delinquency may be 10% right now for Pat, he's not charging late fees, which probably would account for another point or so of billings that are not being received. So there are more consequences than just that number. But yes, we are pleased right now where things are.
Do you have anything to add, Stephen? What's it looking like from your end?
Yeah, I think what we're seeing in our portfolio is really interesting, and I think the main theme that we're seeing is that it's very spotty. I find it really interesting what the Pat statements and Norm statements, because I guess if they're collecting 90% or Norm is like 88%, what that means, and if the average of the country is 80%, what that means is that there are some people that are collecting only 70% or 60%. We have some clients that haven't missed a beat, and so they're collecting nearly 100%. So we know that there are areas in the country that must be just devastated because they're collecting really just, maybe they're only collecting 50%. So it's so dependent on who the renters are, what jobs they had, what industries in the area are the employers of these renters. And what we're finding is that it's very spotty. Some people are not missing a beat, and it sounds like Pat and Norman are doing a great job, but others I think are devastated. And so spottiness is what we're seeing around the country.
I'm going to seg to a question that I just got. The question is, are you seeing more people pay with credit cards than normal right now?
I'll leave that one. I wouldn't even know. I wouldn't know how they're paying. I'll leave that to Pat and to Norman.
That's Norm's.
Yeah, well, I don't have that breakdown, but I will say that online payment has jumped tremendously in the last 8 weeks because our offices are technically closed. There are people in them, but we don't allow human-to-human contact. So the percentage of payments online, either with credit cards or direct bank deposits, has increased markedly in the last 8 weeks.
Yeah, and we're 100% digital. We were before it came in paperless. So yeah, whether it's credit card or whatever, Venmo, or it all comes in. I think it comes in through our website, but we don't really have the breakdown of credit cards.
Yeah, but I guess Ashraf, the question is probably directed at whether or not we think that people are just building up their credit card debt in order to make their rent payment, right? I guess that was the point of the question. I'm not sure. Mm-hmm. I'm not sure.
I'm getting a lot of emails though from companies that are willing to lend rent money to our tenants. So we're not passing that along, but I'm not sure that's a very good idea. We'd rather be the lender to our tenants than some third party charging, 12, 14% interest. So we want to protect our tenants. But yeah. I'm seeing a lot of that floating around the internet, and I'm sure some of that is happening.
Yeah.
Is that a possibility that you might enter into lending? to your tenants?
Well, we are. If they're not paying us,
Well,
we're in effect lending them their rent money. We're not evicting them, and we wouldn't evict anyone. We are offering payment plans and even extending leases to allow those payment plans to be made over a longer period of time. So we're doing everything we can. It's interest free. So yes, in effect, we are lending to our tenants.
Yeah, it's interesting, Norm, that you mentioned that, because we too are putting a program in place where we'll joint venture with the borrower to essentially advance money to renters, enabling them to make their rent payment. And we'll contribute part of it. The borrower contributes part. The owner of the property contributes part of it, and just to really help people out and probably give them, maybe it's 12 months, maybe it's 2 years to get even. So we are seeing that, but I agree with Norman. Very dangerous for a renter to get stuck with some, internet-based, rescue money platform, because people just, they may not be careful about what they're signing, and they're just jumping into a trap. So
It's like
that's a
a,
really good point that Norman made.
it's like a homeowner with a high interest, high equity loan. We all know how that turned out.
Right.
Yeah.
Actually, so this is a good segue, because I was going to ask about 2009. So I was going to say, can you look at 2009 history? Is there any roadmap for how this plays out? What's different and what's the same, and what's absolutely totally different from the last downturn in 2009?
Yeah, I'll take that. I'll take that, since I was involved so much in the Lehman workouts in 2009 and 10. First of all, the banks are on solid ground. That's a huge difference. And secondly, the Fed has acted quickly and has acted in a much more major way than they did in 2009. In fact, I think we're triple or quadruple all of QE in the 4 or 5 years from 2008 to like 12 or 13 when it ended. And so we've done 3 or 4 times that in a week. And that's radically affecting and distorting a lot of markets in ways that are beyond my pay grade, and we'll be writing about in the Harvard Business School, I'm sure, for decades to come. So you have that difference. We have 20%, they say it's officially 15% unemployment. It's definitely shooting to 20. We're now at 1939 unemployment numbers, 1939. And even I wasn't born then. So we've never seen anything like this at all. And we don't know how much of that is short-term, the furloughs, and they'll come right back, or not. And then finally, there's stimulus. There's stimulus and unemployment checks that are much larger than we did in 2009. The stimulus coming through PPP, and we have stimulus coming from ways we don't even understand that are going to distort things and change things as well. And combined, all of that, what does it mean? That's why I say I don't know what will happen tomorrow.
Stephen, you have some thoughts just from, your end?
Yeah, sure. Yeah, sure. I think so I agree with Norman. I'm very happy with the level of stimulus that the government has stepped in and provided. When things started crumbling at the end of March, and spreads started widening in the debt market, even Fannie Mae securities, Freddie Mac, Ginnie Mae securities, spreads were widening, interest rates were really widening out, and the government came in and started buying those securities and mortgage-backed securities, and really kind of calmed the market during that time. But so besides the government stimulus, the one thing that I've clearly seen is the level of compassion in the market right now. I don't remember in 2009 and just that entire period where people were just trying to help each other. I think right now, for a bank to be hard on a borrower that isn't able to make their payment, I think a lender would expect the borrower to call the FDIC on them, because it's just it wasn't right then, but it's actually, even right now, it's just not cool at all, and just inappropriate to be tough on a borrower. And the same way that borrowers or property owners aren't being tough on renters. But I'm seeing a lot of compassion in the market, which will, I think, result in, even if loans or properties are traded, I don't think it happens fast. I think if anything, it'll happen further down the road. But I think things are playing out slowly now. And that's a big difference compared to what we saw in 2009.
Right. And in fact, we call this the era of good feelings, and it truly is. And I think Steve makes an excellent point. The fact is, though, kicking down the can by not, having mortgage relief for 3 or 4 months or 5 months, as it may be expanded as we get close to the election, it only gives developers and owners a time to turn to their business plan playbooks and turn to the chapter entitled Hope. And it'll be really interesting what happens. That's why I think Steve is correct. It's going in slow motion, but at some point, hope doesn't work out as a strategy. And I think you'll see, the era of good feelings start to wane a bit in a few months.
Mm-hmm. Yeah, that could very well be. And just like you said, Norm, we'll have to we'll see how it plays out.
I'll say,
yeah, I'm sorry, Pat.
Yeah, I mean, for me, the similarities are, you had a market that was riding hot, and you have an event. The difference in the events were that was a financial downturn or financial crisis. This was a automatic. Every industry got affected. It was like something we'd never seen before. So I think what you see is a little bit of difference where every industry got affected. Some are wiped out completely. The opportunity is it's going to show you, like you said, some of the operators are going to excel, and some of the developers are going to excel through this. Some of the people are going to excel. I said it before. As Warren Buffett says, you can see who's swimming naked when the tide goes out. And so I think people that were conservatively investing, we're income investors. We look at income and streams. We stayed away from development. I purposely stayed away from development because I saw the developers coming out of last cycle, and they were all, licking their wounds for the first 3 years of the recovery. So I think the similarities are development's going to probably get affected, and things without stable income and real, tenants backing that up, and that's going to be the hardest hit. So I think there's both similarities and differences.
Yeah. And let me elaborate on, I think what Pat is saying, and I agree with him, is that deals in lease up today are under tremendous stress. And they were under stress even before this crisis. And they were under stress because we were building a very expensive product for a very finite market that could support it. And Pat and I generally are in B class. Pat has some A class. But the fact is that our rents are so much lower, and there's enough demand for our product. So that's something that was different in 2009 as well. We had an oversupply of housing. We do not have an oversupply of housing now. We have an oversupply of very expensive housing for a market that can't afford it. And so this was masked by the debt markets that were able to lend based on pro forma thinking that, we're going to lease up. Oh yeah, next year the concessions would burn off, and then there'll be rent growth. That story, as I think Pat aptly said, is now the tide is receded, and now you can see it doesn't work. And so I think there's going to be stress in that particular submarket of multifamily, but where we're playing in our portfolio, we're going to be fine.
Yeah, Norm, I'm just wondering whether or not you think that there's going to be a trickle-down effect into the B market. So if the A units, right, the high-end luxury units have to reduce their rents in order to just get people in, right, is that going to affect your market?
If it does, it's going to affect it only in our most successful longer-term held projects where our rents moved up to market and our renovated product could compete with Class A's if they reduce the rent enough. That's going to be the second stage much later. First, there has to be capitulation by the developers to lower the rent instead of playing the game of having high rent and then major 3 months of rent concessions.
Yeah.
And once that happens, some of our tenants in our higher price properties may be able to qualify for those rents. And yes, there could be some loss of occupancy there, but I don't see it like in '09 happening because there is no oversupply of housing.
It's a little bit of apples and oranges too, where a lot of the development stuff was geared towards millennial, small micro units, where they were highly amenitized in, urban core. A lot of what Norman and I do, it focuses on families that either want to be in good subdivisions in the Southeast and Texas markets, but they can't afford the housing. So they're looking for a house like something to substitute instead of buying a house in these suburban areas. So you're not going to, just because the shiny downtown, apartment is dropped rents, that doesn't help you and your two kids who you want to keep in that school district. So like Norman said, sometimes it's that niche top of the market. I live here in New York City, and the top of the market is now, let's just say I became very popular when I said I'm looking to rent a new apartment. The top of the market is wide open, because I think in downturns, people go, oh crap, do I really need that top of the market product? Do I really need that second home or whatever? And those are usually the first things that get cut. The housing for necessity with your kids in mind is usually a good bet. That's why we invested in it in the first place.
Yeah. And I think that, Pat, you're alluding to the fact that home buying, I think, is going to be substantially reduced. You're seeing that a tightening of credit requirements, and you're going to see people who have fear. So the psychology of buying, I think, will be reinforced again, just like it was in '09. It'll take a long time to recover. And people have lost, if 20% of the people lost their jobs, their credit scores are going to be affected, and they're not going to be able to buy homes for a long time. So I think multifamily, I'll tell you a story. This is a true story. It's apropos. A year ago, I was going to the ICSC conference, which is a big retail conference in Las Vegas. I happened to be going to Las Vegas, and the conference was going on. I was sitting on the plane next to a retail developer, and he was telling me his woes, one woe after the other, and I felt so badly for him. And then finally he said, Norman, tell me, what do you do for a living? And I said, oh, I'm in the Class B multifamily business. And he grabbed me by the shoulders and he shook me and he said, it's a pre-pandemic shake. And he said, Norman, you're so lucky. And I think that's, where I think we're in a very fortunate place right now, because people need housing. It's not going to be disrupted. If anything, it'll be in home buying and in the high-end Class A's. And our space, I think, is in a really good situation.
I wanted to move on. Now, you touched on a bunch of things I want to move on to. I just want to address a question, since we were talking about the era of feel-good lending. Someone says, well, when does the feel-good era end? Essentially, what point can you have to cease being compassionate and start to take action on loan defaults or renter defaults? I mean, when does that end? And I mean, and if you're in special servicing, I mean, are you feeling that kind of compassion?
Special services and compassion never mentioned in the same sentence. The good and the bad news is special servicing really has gone out of vogue for the last 6 or 7 years. So they're very lightly manned. And right now there's a rush to fill in resources to get ready for this. I don't think there are a lot of special servicers to talk to right now. And that may be a good thing. But right now I think very little has gone to special servicing in multi, because Freddie and Fannie, other lenders, are allowing the can to get kicked down for the next 3 months. So the question is, when will this end? And I would say certainly, in the extreme case, I'd say by the election, because I think politicians may push for Freddie and Fannie, which are government owned, to keep doing this to create a longer era of good feelings for the election. So I would say sometime around then, we'll have to face reality.
Steve?
Yeah, sure. So at the end of the year, I can speak to the special servicing, and I definitely agree with what Norman said, that historically special servicers have been sort of known as entities that were very difficult to work with, deal with, and even talk to. And lots of borrowers would not do a CMBS loan because of the fear that one day they'd be stuck talking to a special servicer. So I agree with that. However, that said, we actually brought in about 20 billion of special servicing on December 31st, not knowing at all that 3 months later, that business would be in full swing. So what I would say is, our attitude as a special servicer is, we are trying to break the mold. And, we don't want to take advantage of anyone. We're trying to, as soon as the team came in, we talked about how we deal with borrowers and try to do everything in a compassionate way. We're seeing a lot of hotels coming in, retail malls coming in. Already there was probably in April, I think somewhere between $1.5 billion and $2 billion of the 20 had already come into special servicing. And, but again, Norm's right. We're not seeing multifamily coming in. Multifamily seems to be holding its own, as does industrial. But hotels and retail are coming in swiftly. How long lenders can wait for the payments to begin being made? That's really a good question. But a lot of that depends on what the value of the underlying asset is. In other words, if lenders, there's a constant analysis going on as to, if we decide not to be patient, what are the alternatives? If there are no buyers out there for the hotel, then what's the reason to rush? And maybe it's, as long as you have a good operator in there and there isn't much of a market, why not just let's work with the operator, see what we can do, and kick the can down the road, and hopefully the economy will come back. But again, as Norm and Pat have said, we don't know the timing of it.
Let me. Do you have anything to say, Pat, or should I move on to lending?
I can always say something if you want. I mean, look, I think collectively what the government's trying to do, what everybody's trying to do with these lenders, is they're trying to freeze in time this time when everybody's quarantined, when businesses are shut down. So these benefits are going in and they last through July. I think the government's saying, hopefully by July the economy's going to be open back up, people are going to be hiring again. And maybe that's all we need. So I think, once you start to see the government support burn off, these lenders are going to be the next ones, to use a phrase I love, to rip your face off. These lenders did not get compassionate overnight. They're just having to follow the lead of the government at this point.
Well, so let's move on to lending. So, in terms of right now, are there what kind of changes? I mean, are there banks still willing to lend for new acquisitions? Have the agencies changed certain standards? What's happening right now if you're looking to get a loan for acquisition?
Yeah, so I guess I can take that one. So no question that the banks and the agencies are being more conservative. No doubt about that. The agencies are imposing debt service reserve and escrow reserve funds being set up that they never did before. They're being very mindful about how collections are going in that specific month that you want to close your loan. And but the agencies, they're in business, they're making loans. We're seeing a lot of borrowers coming in, notwithstanding everything going on, and just wanting to reduce their interest rates. So we're locking a lot of interest rates at these historic lows, and we're seeing banks. We're definitely seeing banks not stretching, but definitely being there for their best clients. So I don't see the market having shut down. I see things moving forward, but just in a more conservative way.
Steve, I haven't followed up since, but at the beginning, Freddie and Fannie had phone calls with us as select sponsors discussing the deluge of applications they received right after the pandemic was declared. And of course, there's a big widening of gaps in the spreads because of that, and for other reasons. How's the volume now versus, say, 6 weeks ago?
Our volume has actually increased, and we are closing loans and bringing in business ahead of schedule. But it's not one shift, Norm, has been, it's instead of being 50-50 between acquisitions and refinancing, It's more like 80-20 now, 80% refinancing as opposed to acquisitions.
And on refinancing, you have time and patience. We're looking and saying, hey, every week, like last week, Freddie Mac reduced its spreads 20 bips, which
Yep.
was I think, the third reduction it had done. And so we're saying, hey, if we need to refinance some of our properties and we're not under any pressure of a loan maturing, why not wait a couple more months till things settle down more, and those reserves may go away, and the spreads may narrow even further. What's your thought about that?
What I would say is if interest rates work now, I mean, the interest rate market has just been, there's so many factors that determine the market. If people get a sense that the market is springing back, I don't know if it will, but if they get a sense that it will, interest rates can jump. There's just a lot of factors with interest rates. If a refinancing worked today, I don't know that I would put it off. If in terms of the reserves, even under the new regulations right now, if your property performs as it's underwritten to perform, the reserves are released after a year. And so I don't think that that would cause me to delay. That's my sense.
We were talking about, are we talking about the 12-month debt service reserves that's now being?
That's
required?
right. Yeah, that's
So,
right.
I mean, okay.
Well, you
So,
can't,
yeah.
well, the
I'm
agencies
sorry. Yeah.
the agencies can't be saying, hey, you don't have to pay your interest right now because we know you're under stress because rents are collections are down, and then lend more money without having reserves for them. They'll just be lending into to borrowers who then can't pay their interest day one because no one knows what'll happen in May and June and July in collections. The assumption is 4 or 5, 6 months from now, things will stabilize and the reserves won't be needed. And as Steve said, the money will be released. But today, the agencies can't lend on one hand, and meanwhile, you're forgiving loan payments on the other.
Yeah, but in fact, but they are certainly lending more conservatively and requiring the escrows, and at the same time, they are, requiring the lenders, and the lenders want to provide forbearance to the borrowers. But again, they're only requiring the reserves when the loan to value level is higher. Right? When it's only a 60% loan to value or something lower, you're not requiring the reserves.
Yeah. Where we borrow currently right now, there's no difference. The thing that's stopping us from transacting and from buying is the lack of available opportunity. There's a bid-ask spread right now that's prohibiting transactions from taking place. And I think it's because everybody's trying to figure out what this loan market is going to do. What's Fannie going to do? Do you have to bake in the interest reserves, et cetera? Once there's clarity on that, or, I like to say it's supply and demand. Once somebody steps up and starts buying and proves it out and everybody gets comfortable, the market's going to pop back up. And you'll see Freddie kind of have to compete as well. But we're 60 to 65% borrowers. The life companies and the banks, as you say, are out. So, outside of the bid-ask, spread and buyers and sellers not coming together, we would be as business as normal, I would think,
Let me add some clarity to the market and valuations, and only some clarity. I can only speak in the past 2 days, not the next 2 days. But we had a property on the market, and the call for offers was March 13th, Friday, March 13th. Well, March 12th is when the pandemic was declared. So even though we had about 100 tours and buyers got the chance to see it and tour it and underwrite it, we withdrew the call for offers on Friday because of the pandemic. So we decided that's a perfect property to go test the market. So last week we went back to those 100 or so buyers and said, hey, we'll take offers now. And on Friday night, we got a matrix of 19 offers for this one asset. Now it's unique because everyone got a chance to see it. Everyone got the chance to tour it and to underwrite it. And we got offers. I don't have a sense of the valuations. It's probably about 8 to 10% below what the broker opinion of value was in February. But there is a market now forming to buy.
We bid on it.
Yeah.
I didn't,
Yeah.
Pat, I didn't see you on the top of the list. I only looked at the top 5.
Well, I figured I'd get a little, yeah, I'd get a little, credit for being on this call. Maybe we could talk, and I could creep back up the line.
All right.
But anyway, I'll come strong, buyer, best and final.
We got real live transacting. Sorry, go ahead, Stephen.
It's interesting because Norm and Pat, my sense is that your portfolios are primarily just your multifamily portfolios don't have a high commercial component to them, which is interesting because on the other side, mixed use properties, for example, let's say New York or some of the more dense areas, the borrowers that we're talking to, property owners, are being absolutely decimated on the commercial rents. So they may be getting 0 commercial rents in.
Yeah.
And in addition to that, their multifamily collections, even if they're in the 90s, depending on how much of their income was commercial, they're feeling a lot of pain.
Right.
And so it could very well be that opportunities for you and for the market will be buying properties, right, where there is a commercial component to it, but borrowers are really having a rough time.
Stephen,
right? Anyone with that?
You see how committed I am to my business. That's why I moved up here to New York City. I heard the same thing. So I'm out there, looking for these guys that have a lot of retail exposure with their multi.
Right.
Well,
that might be a good move.
I'm getting back to New York City because we definitely have some queries on it. We did have one question about kind of the agencies in the future. So if you take out your crystal ball a year from now, I think the question is basically, where do you see a year from now any changes coming to LTV volume markets as from the agency perspective? What do you see?
I think we're all hoping that the market is more stable and that that what we're seeing now on collections, which is that they're coming in better than was expected, if that continues and maybe it starts even climbing a little bit, then I think that the agencies will hopefully get back to where they were. And because we all know that the agency default rates were extremely low, and it's been just a very successful program. Multifamily has been a very successful program for the agencies. And so we're hoping that the reserve requirements and some of the more conservative views that the agencies are taking will kind of slowly move back to where they were before, hopefully. But a lot remains to be seen based on how collections are going to come in.
Yeah, and I think that's right. And that means in the LTV formula, it's the V, not the L, that's going to really dictate this. And so how do you determine the value, even if the rent is collected? So much in New York, you saw this when rent control came in and put these draconian rent control laws in a year ago. The cap rates on multifamily in New York went from like a sub 4 to a 5.25, not because all of a sudden people thought the rents would, people would stop paying rents, but you could not impute rent growth. And so very often people are capping future rent growth in valuing properties. So today, right now, you're not going to see it as much. Appraisers, Freddie Mac and Fannie Mae require appraisals. Appraisers go back and look at comps 90 days old, right? And 90 days ago were closings on deals that were marketed in December or January or even November. So you're seeing Q4 values as current appraised values. So when you go to Freddie Mac today and say, hey, I want a 70% loan to value, here's the value on the appraisal. The question is, what will that look like 60, 90 days from now when the retrades that happened during this pandemic period are booked and become the comps of the future? So it's not the L, it's the V. And that V is based on what you value the cash flow at, right? What the cap rate will be, and also what those rents are that you're capping.
I think the saving grace for all of us is where that 10-year treasury is. It's sub 1%. What's a cap rate on a multifamily deal with a 1% 10-year, So I think as long as they caveat any bad stuff with lower, if the treasury keeps ticking down, that's going to save us all, I think, on the valuation, I hope, But, I like my chances of borrowing at 1% and levering a cash flowing asset. It's, it should be a good time for us.
Yeah, I think that's a very good point. But I think, and I think to Norm's point also, value is really a relative thing that kind of moves around, and no one can use what happened 90 days ago as a determination of value. What we can do though, and what I see the agencies doing, and I think what all lenders are doing, is we're really looking at debt service coverage. And so we're looking really hard at and even debt service coverage, we're not going back 3 months. We're looking at what happened in April, what's happening in May. And that's what we're using to determine, or to try and determine, what the future cash flow is going to be. No one's going back 3 months and taking any comfort on what happened 3 months ago. So I think it's cash flow in multifamily properties is king right now. And that's what we're very focused on.
So, I mean, let's talk about opportunities. I mean, so where, I don't know if it's the time yet to talk about opportunities, but where will the opportunities be for all of you, you know, in the next 6 months? Pat, you mentioned, you want to talk with you. You said you're in New York looking at retail dependent multifamily.
Tell me how that's going.
Oh, no, I mean, I'm just walking around the street up here. It's not a business plan yet. It's not a business plan until it works. But, you know, I think what we're going to be doing is doing a lot of, look, we're going to use the strength of our company. And just like Norm, we're select sponsors of Freddie Mac, Fannie Mae, whatever. Freddie and Fannie, you know I love you. We're select sponsors of Freddie and Fannie. So, you know, yeah, things have tightened a little bit, but I think if anyone's going to get preferential treatment, it's going to be the tried and true borrowers that, by the way, came through this downturn looking really good. So we're going to use that to probably double down on our current strategy of buying in a lot of these business-friendly states. We're going to pay even more attention to where these jobs, where the residents work. So we did a pretty good job at that before, where it's just a math equation. You look at where the average income is in that area, and you don't get too aggressive. You don't try to trick yourself into believing, you know, people can pay more than they actually can. On an opportunistic standpoint, I think any development deal right now that's either midway or topping off is probably a good opportunity. Developers probably don't want to admit it yet. They're probably getting leniency out of their lenders. But as soon as that slows down, they will face the music. And you know, it's a tough time to be a developer. Developer seems like they get 2 good swings on the cycle, and then they lose everything they make. And that's why I stayed out of it the first time. So, you know, it's not going to make me popular with developers, but I hope I'm the first guy they call.
Yeah, and this stress that Pat's talking about was there before the pandemic, but it was being masked this way. I was a panelist on a conference in December, and I sat in the panel before mine, and it was a hard money lending panel.
Mm-hmm.
I was very interested to see what was going on with hard money lenders. I didn't know any of the companies. I didn't know any of the so-called experts up there who were giving loans. And so the question was from the moderator, tell us about a deal you're doing right now. Remember, this is December. Tell us a deal you're doing right now so we know in real time what's going on. So this hard money lender, this balance sheet lender, all of whom are now underwater, said, well, a borrower called us in Hattiesburg, Mississippi, and he was late in delivering his new build product. He was only 50% occupied, and his debt and his mezz debt, his mezzanine lending, was maturing at the end of December with no renewal, and they needed a loan. So the moderator said, what'd you do? And he said, I gave him a loan to pay off the first mortgage and the mezz with its full accrual, and I lent him a 2-year interest reserve, all for LIBOR plus 4 1/4, and with 1 point or 1.5 points. The moderator said, don't you think that's a little risky for such a low interest rate? And he goes, nah. He said it's almost stabilized. And I'm going, oh my gosh.
Yeah, what he really did was buy that property.
Right. And what should have happened is that developer should have sold that property. He would have lost his equity. The mezz would have lost something. It would have gone into the stream of commerce at a lower basis. The new owner could lower the rent and fill the apartments. That's what should happen. That's what should have been happening this last year, and was masked by all these lenders who were assuming lease ups and the burn off of concessions and rent growth.
Yeah.
And I think that's now gone. And I think now it's exposed, as Pat mentioned before. So I think that's going to be a really good opportunity. The other opportunity I think is, so many new owners who've come into Pat's and my space in the last 2 or 3 years who really are in it for the money and not for the passion, and don't realize how labor intensive and difficult it is to manage a Class B apartment complex, especially one that you may be renovating while it's occupied. It's not an easy thing. And so some of the properties we sold, I would call it price to perfection last year and the year before. We're not perfect. So, and I know the buyers who bought from us are not, certainly not necessarily as good as us and far from perfect. So now that they're losing 6, or maybe like Steve said, 10 or 15% of delinquency today, when they were predicting 5 to 8% rent growth, I think they may be in trouble. So
I think the other overwhelming opportunity will be finding a use for all the vacant retail shop space and theaters and gyms and everything. So somebody's going to do well coming in there and saying, okay, can we repurpose this for life sciences? Can we repurpose this for medical use or whatever? But I think the days of endless retail space and a mall on every corner, that's now coming down. So if I were starting in the business again, I don't know if I'd get into the most competitive space like apartments or industrial. I'd probably go look at the retail space and how can you make those type of deals work, because that's where you'll see the most distress and probably the most upside.
Yeah. You may actually see opportunity in buying these now closed hotels and converting them to multifamily, because as we noted, we don't have an oversupply of housing right now, and converting that the hotel stock, the housing stock, may be a good trade to look at in the coming year or two.
Yeah, what I would say in terms of on the lending side, the opportunities that we're seeing right now, I think kind of just distill down to what we'll call gap capital, right? We're seeing borrowers that need to refinance their loans because their loans are just maturing, right? Where the new loan cannot be sized in such a way that it can repay the outstanding loan. And so what the borrowers are looking for is they're looking for kind of that mezzanine loan, that soft pref loan that can enable them to pay their loan off at maturity. We're also seeing borrowers coming to us telling us that they have a limited partner that got in trouble either because their stock portfolio got hit and it was on margin and needs cash. And so the general partners are having opportunities to, at a discounted value, buy out their limiteds. So they're coming to us and asking for this additional capital. So I mean, the theme of it is essentially subordinate capital behind the senior loan. We're seeing all sorts of desire on the part of borrowers to access that type of capital. We're seeing that almost across the market.
Anybody have any more thoughts about hotels to apartments? Because you hear a lot about hotels that at this point are not viable. I think, Norm, you had told me that if somebody gave you a hotel for free, you probably wouldn't take it today. Where does this happen? I mean, is this a strategy that all of you are considering? Are there certain markets where this makes sense and ones where it doesn't?
Yeah. One area that we're looking at right now is the acquisition and conversion of limited service hotels into homeless shelters in urban areas that are in desperate need of housing for the homeless population. And New York in particular has so many programs, whether or not it's for single mothers or whether or not it's for families that want to stay together. So there are different demographics even within the homeless sheltering universe. And so limited service hotels might be very good for single mothers, whereas it probably wouldn't work for families, larger families. But so we're definitely looking at the possibility of acquiring and just repurposing limited service hotels into homeless shelters in urban areas.
I think it's urban areas for sure. It's the whole highest and best use. You know, you walk around a city like New York and you see a lot of buildings that are great buildings, great locations, but their current use doesn't make any sense. And so, you know, one theme that I was looking at prior to COVID was these boutique hotels where, you know, if you're a businessman and you're traveling, say, from New York City to London in a common rotation, it's something where, you know, a lot of these hotels down here, the Mercer Hotel is one where I stayed, where they rent hotels a month at a time. And it's kind of cool because you come in and you have your place where you can have your meetings, etc. You know, converting some of these hotels from strictly hotel to, you know, niche little uses like that, I think is an interesting play. Definitely depending on their location, but in a city like New York where you don't have much square footage anyway, and it's really dependent on the location and amenity set, I think that's going to be a good opportunity.
You know, it's interesting you say that, Pat, because I remember 2 cycles ago, in 2002, 2003, I was taking over development and foreclosure in Boston, and the Ritz and the Boston condo market was very weak. And so the Ritz-Carlton had a condo tower right next to our project, and they couldn't sell it all. So they cut it off in half and had a separate elevator bank for the lower floors and made those long-term corporate hotel apartments. And that's where we really stayed when we were staying for weeks at a time to develop this building nearby. And so what they did is they sold out the rest of the building. It took them several years. And once they did that, they reconverted the long-term hotel portion into condominiums again. So it was a sort of a purgatory move until heaven reemerged.
Real estate's like fashion. Everything comes back in style eventually. You know, and there's no original ideas either. So yeah, I love it. I probably read that somewhere.
So we have a question about New York City in particular. In terms of, well, first of all, you've already had an issue with the rent reform law that has probably impacted valuations and just impacted, well, the general multifamily market. So I think the question is where do you see New York City valuations, New York City multifamily investment going at the end of the year? What do you think lenders' attitudes will be towards lending to acquire in New York City?
I guess I can take that. Even before the pandemic, New York City multifamily was a problem because of the new rent regulations. And so literally, hundreds of millions, maybe billions of dollars of equity have been lost just in the last year, because investors that were buying multifamily properties at 2% and 3% cap rates, hoping that they would get in, renovate the buildings, and raise rents. That game plan just absolutely fell apart when the New York legislature passed the new regulations. So even before the pandemic, New York City was having a problem, and investors were really struggling, and banks were finding themselves with over-leveraged loans. Adding onto that situation now, with renters not being able to make their rent payments, makes it even worse. And so people were already thinking before the pandemic that these properties that had been selling for 2 or 3% cap rates were going to jump back up to 5.5 or 6% cap rates. But now with the pandemic and rents not getting paid, it could be much worse. And so there's a lot of issues with the New York market. And I see Pat smiling because he's not an operator in New York.
No, exactly. I'm coming in as the dumb new guy, but I also know when things sound horrible, especially in a city like New York City, that is the opportunity. New York City is a time where you get a chance in life, maybe one time, to buy at the right time. And if people are down on multifamily, I was looking before this downturn happened. I was up here and I was trying to figure out the rent regulation noise, because you're right, everybody was over it. And now you top it off with this, it's going to be a big, hairy problem, and those are usually the ones that people say, not for me. Well, I like those type of opportunities. You come in and you figure it out, and then you look up and you're the next Sam LaFrac, I hope,
Patrick, having started in New York, and I was a lawyer for HPD, Housing Preservation and Development when I first started in charge of their in-rem program, their tax foreclosure program. Let me just tell you that that is not something you're going to figure out.
No. And being an entrepreneur, being an entrepreneur, I also love it when everybody tells me I'm wrong. But
Yeah.
like, you know, I agree with you. I mean, I also operate under the life is too short category too. So I'm up here for the food and the fashion. And if business opportunities happen to present itself, that's icing on the cake.
Yeah.
But I do know there's something about New York that draws people around, you know, the world to this place. And if I find an opportunity, I will jump on it.
Well, I'll tell you that and this is what this is why New York is in such trouble. So I spoke at what was called an affordable housing, small a, affordable housing conference in New York Law School a couple of years ago. And I was on the panel with a local developer building micro units and someone involved from Goldman Sachs in the 80-20 program, the affordable housing program in New York, where they set aside middle income units and new development in exchange for some concessions. And there was also a broker who dealt with affordable housing. And so I was the fourth panelist, and so the other three New Yorkers lamented for 20 minutes before I got to speak about the regulations in New York and how they were built for tenements when they needed cross breezes back 100 years ago. But now we have air conditioning and we have millennials and we need smaller units and they need lifestyle versus the apartments, and the city regulations are so far behind, and an 80-20 program, how slow the city was, if they only did this. And I just heard all this about these regulated programs and how New York was so slow to respond. So when I got to speak, I said, hey, you just heard how it's done in New York. Let me tell you how we do it in America.
Yeah.
And then I talked about what Pat and I do, which is we buy low, we renovate, we give a good quality product for a value that people can afford. And then one of the panelists turned to me and said, well, if you renovate, how do you pay for that? I said, well, we raise the rents and get an ROI, a return on investment for that improvement. And she said, what happens if they don't pay the rent? And I said, well, then they'll find another place to live they can afford. And she said, well, I just find that morally offensive. And with that, there was a standing ovation in the audience.
Yeah, it's unbelievable.
And I said, listen,
Unbelievable.
The most regulated, I've never heard this before.
Try that at Cipriani's.
Yeah. So
when they bring your bill, tell them, look, I think it's morally wrong that you're asking me to pay for this meal right now.
So I said, look, the most regulated cities, rent cities in America are San Francisco and New York. Which are the highest cost of living apartment, rent cities in America? San Francisco and New York. Maybe there's a connection. And so I got booed.
I'll tell you the truth, though. After COVID-19, we're all regulated.
Yeah.
We've all been grounded. We all got home arrested. Norm, we can't evict people if we want. So regulation is creeping anyway.
It's
so
coming
it's
all
like,
right. It's coming right. The final piece of the story is after the conference, after the panel, people surrounded me, touching me, saying, thank you, we needed that said. And I said, well, where were you during the conference? Why didn't you, say anything? And they go, oh, we can't say anything here, we'll get killed. And
I'll come next time, Norm. I'll be in the stands for you.
It's the entire, way New York operates that is going to be a real challenge for you. Now, having said that, I think there is opportunity there, and you'll see us probably buying a unit next to Pat so I can with them up there. But it is not easy. It's really, really challenging and very difficult. And we'll see what the politics of this all will be, whether it's worse or better in New York in the coming years. And I think that's where the risk is.
Yeah, Norman, Pat, I guess the question I would have is in the reverse. Are you seeing New York investors that were focused on buying in New York that are now moving out of town and moving down to the Southeast? You got to be saying that.
I can have a minion in my reception room almost every day from all the New Yorkers that have come down waiting to talk to me about where can I invest in the Southeast.
Look,
yes.
And
it really increased. It really increased after the rent control law was passed.
That's right.
My institutional investors, I've been having calls with them almost every day. Everybody's talking about the Southeast and after this, being in the city during COVID-19, this craziness, you saw people vacate. If they had a house in the Hamptons or whatever, they drove out. If they could get out of New York City, they did. And I think it's just proves to you that people like more space. They're going to be driven to be, you know, in suburban locations. Businesses are going to be there because they're not going to have to worry about regulations. You know, Dallas, Texas is the best place in the world for business because you can do almost anything as a CEO. It's cheap to live there and your employees love it. And so I think you're going to see markets like that boom and investor capital will follow it. I think New York City, I never really agreed with the all in, all I own is New York City. I think it's a niche strategy, a great one, but it can't be your entire portfolio.
So I just want to talk a little bit about regional differences because I'm getting some questions about New Jersey. I'm getting some questions about Florida. I think overall, what about, I mean, there were a lot of assumptions that went into the COVID-19, but are we seeing a lot of relocation? Things that, you know, this idea that maybe people don't have to live where they work anymore after this is done. People will be moving even further to lower cost, lower tax states. I mean, does this accelerate certain shifts? And do those, I guess, do those relocations inform where you might want to invest next? I guess it's a multi-question.
Yeah, I mean, they definitely do. Internet is driven people. People used to give me the advice that you wanted to make New York City money and pay Atlanta, Georgia expenses. And so I think if you can do that now virtually, you know, if you can keep your job and maybe go down to Charleston, South Carolina or somewhere and rent an apartment, but still make the same salary and just do your job, you know, virtually, I think that's a smart play. I think a lot of people do that. I think investors are going to watch where people move and where jobs are created, you know?
Yeah. So listen, right now it's anecdotal. Anything we say is just our feelings. There's no statistics on this. We'll see when we reopen what happens. But anecdotally, you're seeing a lot of New Yorkers who went back home, wherever home was, to be with their parents or family to ride out the pandemic. And all of a sudden they're writing and talking about, hey, life here is pretty good. There are trees, there's not a lot of pollution, there's not a lot of crime, there's not a lot of dirt. You know, hey, maybe New York isn't what it's cracked up to be. So I'm hearing that anecdotally, but, you know, time is going to tell. I mean, really, people talk a lot. You know, when President Trump was elected, you know, Barbara Streisand said she's going to leave to Canada. So did a million other people, and no one left. So a lot of people are threatening that I'm not going back to New York, but New York is still New York. So we'll see what happens.
Yeah, I think it'll be really interesting because one thing's for sure, everyone's asking themselves the question, right? Do I really need to be in the city? And some people will say yes, and others will say no. The question is, what are those percentages? So yeah, but it's really the first time that everyone's asking themselves the question.
Yeah, the interesting thing will be, it's going to be dependent on, I think coming out of a downturn, people do less of what they want and more of what they have to do. So if you have to be in the city or else you can't take the subway because they've got new regulations keeping the number of people on, you may have to get a place in the city, you know? But if you don't have to be in it, I think people are going to be driven to where necessity takes them coming out of this thing.
Yeah.
I have a very specific question came in about Orlando. Somebody wants to know if you feel that there's overdevelopment in multifamily in Orlando.
I can talk on that. I mean, probably. You know, we have a big portfolio in Orlando. We don't compete against the new development product as much. We're probably one tier down. But Orlando as a market has been one of the softest. If you look at, you know, the major employers there, Disney World's one of them. And, you know, with them being shut down, it's caused a lot of softness in Orlando specifically. So if there was overdevelopment in Orlando, which is likely, it's probably it's probably even worse right now. So I would say, yeah, it's probably likely overdeveloped.
Pat, are you seeing collections hit extraordinarily hard in your Orlando portfolio?
Not really. I mean, we're still in the 90s for collections, but as a whole, that's clearly the softest areas. The conversations our employees are having with residents, you're hearing the most, you know, troublesome stories and things like that. So out of all areas, that's the one we've kind of been most paying attention to.
Yeah. So we have a small portfolio there, probably a step or two below Pat's, a solid B class assets. They're doing fine, and they're actually their virtual leasing is working probably better than a lot of other properties that we have. Obviously, we couldn't teach virtual leasing in the classroom. We had to do it on the fly and do it through Zoom, but it's working really well there. And we usually use it as a test case to show people how it's done. But what I did hear on Friday in a internal call was that, and I haven't seen the data to support this, but institutional money or organized capital is actually looking at Orlando as the rebound city, one of the top rebound cities after this crisis is over. Now, I don't know how what data came into that conclusion, and I don't know who's making it, but I was told by my investment sales guys that there is a lot of money that's banking on Orlando and a speedy recovery there. But I can't give you any details as to why yet.
Yeah, my sense, Norman, on that, on Orlando, I've heard the same thing, that there's opportunity down there, but not because they expect a speedy recovery necessarily. It's that they think that there's going to be more wholesale selling, fire selling of properties by banks. So that's what I've heard. And it'll be interesting because you're right. We just don't know how it's going to play out. But I've heard the same thing about Orlando.
Is Orlando or Florida?
Oshrat, if I can, we talked about New York. I just want to tie it in. Steve talked about banks selling assets, which means they have to get control of those assets. I was talking to a lender who has exposure in New York and said, I will never lend in New York again unless I have a UCC lien, because the courts are just horrendous. They're anti-lender. He's in a lawsuit now, I think 15, 16 months, waiting for summary judgment on a mortgage foreclosure on a project in Brooklyn. So it's so difficult to get control of an asset. And but in Orlando, it's non-judicial and it's very quick. And so I think you'll see, because of that, Orlando will heal faster because they'll get product out into the stream of commerce and let people like Pat and I rescue it and fix it faster.
One other thing, which is about New York, any idea about some condos that are, condos that might become rentals that you'd want to get involved in, or that you see that happening in general?
I do, yeah. I mean, they're going to have to figure something out. I think the buyer pool, especially on the international basis, imagine if you had just spent $50 million on a condo in New York City and you live outside the country and they just close the gates. You can't even come to your apartment. And so if you're not a resident, so I think the international buyer pool that was buying up all these high-end condominiums in New York, this is not a place where you want to go if the next COVID breaks out. So I think that buyer pool is going to be slow. I think it's going to have a similar effect probably after 9/11, not that I was active in it, but after 9/11, probably people were afraid of skyscrapers in New York for a while. So I think as those developers deliver, they're going to have to come up with a better use than just selling high-end, $10 million plus condominiums.
Yeah, and I think it's interesting. I heard a term about a year ago for the first time since like 2006, and that was what's a phrase, inventory loans. So that developers of high-end condos weren't selling fast enough. Their construction loans were coming due, and they were going to banks to get inventory loans on their leftover inventory that was unsold, and that's always a dangerous thing. And so that was the first signal to me that New York was overbuilt and that there's going to be softening in the market. It will be interesting to see who's going to be making the decisions, as Pat said, about what to do with these condos. Will it be the developer, or will it be the mezzanine lender, or maybe the bridge lender that gave inventory loans? We'll see who's making those decisions.
We have a question overall about rent burden, which actually has been an issue, right, in the last near decade, that, basically rent as a percentage of income has been growing. I think rents have been growing faster than people's incomes across the country, really, regardless of market. So does that change after this crisis? Do you think that essentially, I guess, people are somewhat not optimistic about income growth, but do you think that rents could be more in line with people's income?
Depends on how much income they make. But I mean, in the markets that we concentrate on mostly, I think, that's a big thing that we pay attention to is how much of income coming, how much income a person makes are they allocating towards rent. So, if we look at a property and the residents are allocating above normal percentage of income to pay rent, we're not interested. because, no one wants to be, borrowing a lot of money based on a weak income stream. And if your borrower's barely making his rent payments, that's probably not a good property to buy,
Yeah, and we've tried to be very, very sensitive to that question, Oshrat. That's why our typical rent's about $1,100, and our typical tenant makes about $46,000 a year. So that fits into that standard old formula of 4 to 1, 4 to 1, 3 to 1 on 3 to 4 to 1 on income to housing costs. But I'll tell you, I went into an apartment once, and it really struck me because pre-Zoom, but they had a big whiteboard as soon as you walked into the apartment, and in it was the budget of this tenant. And she had everything down there, our income and everything. And I looked at it and I said, wow, it doesn't work. She can't make ends meet. She was writing it right there. It was right there for me to see. She could not make ends meet, even though her rent was like $800. And so I think this is a really important issue, and it's something that we're going to have to tackle as a society, not just as an industry. But don't blame the landlords. You can't charge rent that won't pay the mortgage. But we have to be sensitive as landlords. We have to provide, and that's what we try to provide, a really quality product for a value that hardworking people can afford, and not go for the glitzy towers and those and the shiny, isn't this great? But let's build a Ford that people can be enjoy living and afford to live in, and something we're proud of presenting. So that's something we really have to focus on. But I think it's going to get worse because, 20% unemployment, do you think incomes are going up next year? I doubt it. I think they're going to go down. If anything, the pressure will be down on the resumes that I'm getting now in our office. I can't believe it. I mean,
one of the things you'll see, you'll have to see more of, which I've seen up here in New York, we don't have it in the Southeast and in Texas, is roommates. People have random roommates they don't even know. They pass each other in the hall and they wave, and that's commonplace up here in New York. So I think, unfortunately, people are going to have to pay what they can afford. And if they can't afford it, you're going to be looking at people doubling up with roommates, etc.
Yeah, but I think this is going to cause a political problem. It already is. We didn't mention when you're talking about New York that the rent strike movement is starting in New York. It's and AOC is fanning the flames of that. And even if it's not successful, anyone investing in New York has to be more concerned about that. It goes to the issue of the way New York perceives the world that I experienced at New York Law School 2 years ago. And I think that's something we really have to consider, is the political situation that this have and have not divide is causing, and the pressure that we're seeing on working people to live a decent life, even though they're working so hard and can't make headway. And I think that's something we as a society really have to deal with, and we have to deal with it sensitively, and we have to deal with it compassionately.
Yeah.
Yeah.
I was going to say, it's not sensitive, but I remember 20 years ago reading about, what I want to do when I grow up. And I realized that there was guys like these business guys and these guys that did, professional athletics and other things that made more money than, say, the person that worked at the grocery store. And so I worked really hard to be one of these guys. And I think we got to, as a society, that may not be popular, but you have to get back to a meritocracy. If you work hard and you save your money, you advance. If you don't, there's got to be something. It just can't be like, look, here's the guys that work hard, and let's just keep them in a level playing field and throw stones at them.
But Pat, if the rents are going up as they were in the last decade, 7, 8, 9, 10% a year, and every other expense was going up, and you're working 2 jobs, and you have 0 at the end of the month to save for, even though you've done nothing but live frugally, that's not a system that can sustain itself without some political duress, and we have to fix that. And
they should fix the college universities that charge hundreds of thousands of dollars a year and then give people no opportunity. There's a lot of things people spend money on that don't really seem fair in hindsight. So I'm not a politician, I'm a businessman.
Yeah, but I don't think there's anything about the current pandemic that will necessarily change the change the willingness of people to spend, 50% of their income on rent. I don't see anything that's going to fundamentally change that. I think Norm and Pat are correct. I mean, if there's a change, it'll be some reason other than that. Maybe it'll be political, but it's not going to be the pandemic that forces people to say, hey, I don't want to spend 50% of my income. It's going to be some other reason. But I think that's how it happens. I think you start by maybe paying 30% or 35%, but then your food costs go up. Your income doesn't go up, but your food costs go up, and things start going up slowly, and then you just get pinched at the end. But we're seeing in urban areas, there's just a very high percentage of people's income that is going to pay rent, which is sad.
I wanted to shift because we're just about 10 minutes out from our stop. So I kind of wanted to think a little forward. I was wondering if you're looking at some practices today, whether that's virtual leasing or certain things that you've had to do because of the pandemic that make good practice even when this is done. I mean, does virtual leasing stay? Are there some other things that you realize that you can do leaner because you have to have fewer staff that make sense to continue when this is all done?
Sure, I'll start with that. We started, I think 20 years ago or so, LRO was invented, which is the management software. They say it's AI. It really isn't that intelligent, but it offers some intelligence in managing rents. And you can set your occupancy levels and what have you, and then it adjusts rents for you up or down on an hourly basis, actually, if you allow it to. So we have been doing that, I think, since the 90s. That's been available, but nothing major has happened since then until recently. About a year and a half ago, we went to a real, true artificial intelligence leasing system called Lisa, and we rolled it out. We were the first beta test. We rolled it out with one couple of properties, and we were shocked at what it could do, because it actually could speak to people who called in, answer all the calls, populated all the CRM, which usually got missed by overstressed leasing agents, set up leasing tours, follow up with the resident. It was fantastic. And then it was bought by Appfolio and taken off the market for a while until it was integrated into their system. We called them up and asked them, just when the pandemic was starting, we started our COVID committee in the first week of February, and they built for us a bolt-on system that allows Lisa, our artificial intelligence leasing software, to now give virtual tours. So artificial intelligence will give virtual tours for us after hours. We also want virtual tours. We're going to do that in a few months, but we accelerated that across the entire portfolio as well. So we have human-to-human virtual tours. It's spectacular. I can't believe it. And I'll tell you that in the first, we saw it ramp up week after week after week as we got better at it and the market adapted to it. I'll just give you some statistics. In the last 2 weeks, we have almost the identical number of tours that we had 1 year ago for the same property, the same number of applications, and the same number of approvals. So we are actually leasing at the same rate that we were leasing when our leasing offices were open and all our amenities were open last April and May, which I just think is remarkable. And what that means is that we don't have to rely on people inputting things on the computer and taking time away from providing service, that we actually become more service focused with our staff who don't have to go type in, into the system every time they want to do a lease or change something. So I think there's going to be we can change the way, once this is over, we can change the way how our people work. They can work with more flexible hours. We can provide more service and less time on a computer. And I think it's going to be fantastic. Pat already talked about all online payments. That's here to stay. So I think there are going to be a lot of differences in how we manage our properties more efficiently. We'll save money. We'll provide better service. We'll give a totally different kind of experience. And I think that's great for our industry, because it actually had been pretty slow to react to technologies in the last 20 years. So I'm really excited about it. But the fact is, that the four walls of an apartment and providing heat, hot water, and air conditioning is the fundamental need of every American, and that's not getting disrupted by artificial intelligence or technologies of any kind. You can say there are tweaks here and there, still got the same four walls, still need heat, still need air conditioning, and you need hot water.
Any other best practices that will linger or continue after this pandemic fades?
I think this is for businesses in general, but working from home has proved to be an effective concept. I think productivity is up, for companies across the world. And so, I think as part of our strategy going forward, we're going to adopt more, working from home for sure. It's not going to be something that is looked at as anything odd. I think now that everybody's, accustomed to it, you're going to see a big swing. And I think how companies, require their employees to commute 2 hours this way, 2 hours that way, they'll probably be more lenient towards work from home and satellite strategies.
Yeah, we certainly will.
Yeah, I think I agree with Norm and Pat there. There's no question that the pandemic will have some lasting effects. It's certainly remote working is going to be is here to stay. How much it'll penetrate into the economy, no one really knows, but it'll definitely be different than it was before. No question about that. And I think Norm's absolutely right that now with social distancing, there's more reliance on virtual tours of apartments. That's here to stay. And whether or not it moves faster than it was, it'll probably move somewhat faster, but it's directional. There's no question that more of it is going to happen. So it's how fast and how much it'll penetrate, we'll find out. But it's definitely here to stay.
Just a quick question. Any thoughts about leadership through a crisis? Are there things that you're doing, best practices to lead your staff to lead your properties through a crisis?
Yeah, I think as a leader of any type of organization, or even a leader of a household, when everyone's panicked, it's your job to kind of stay calm. So one of the things I did, unfortunately, I got COVID-19. So I had COVID-19 up here, and I'm now, I no longer have it. I have the antibodies now. But one of the things I did was lead a donation. And so I kickstarted a donation in part to help feed people around the world. And then a second initiative we did was actually giving back to residents of ours that were, in true need. And so we kind of made it a company building thing where our regional managers and property managers went out and talked to these people that were in distress and actually selected the people that would get the money. And so that was something that it went off really well. It made our company feel, our people feel good and secure, and made me feel good. So I think that was a good thing. I'll definitely do it next time.
Yeah. Well, Pat, I laud you for that, and I know I've watched you and what you're trying to do, and I think it's great for you to do that. I think that there are two sets of people. Actually three that we have to protect. We have to protect our employees and give them some comfort, and so that they can then be strong and help deal with our residents who are really under tremendous stress. Can you imagine locked in a small apartment? That is, but doesn't have kids running around like Oshrat you do, and being a teacher to them, but you're in a small apartment, the amenities are closed, you're scared to let them go out. And what do you do for 2 months now? It's just really, for us to be able to help them, communicate with them, make them feel better, our employees need to feel safe and secure. And so what we did the first week of February, and when we formed our COVID committee, was the number one rule, and the first thing I said, and the only thing I said, because everything else I left to our team, because it was groupthink, was absolutely phenomenal to see what happened after this. But the first and only thing I said was, no employee of Radco is going to be let go. No employee of Radco is going to have their hours reduced. No employee of Radco is going to lose their benefits. You are protected, period. End of story, what it costs. And so as a result, even though we have several hundred employees, probably about a third of them are either not working or are working part-time. anyone over 60, anyone with pre-existing conditions, I said, do not show up. Stay home, stay safe, you're going to get paid in full. And so anyone who's working part-time, because we simply don't have the work with the offices closed, that I'm still paying you a 40-hour week and you're getting full benefits. So when you have that kind of security and safety, which I reinforce by Zoom and by email constantly with our employees and through Yammer and other technologies, constantly telling people how safe they are and secure they are and how they're doing something so great, they can then translate that into helping the people in our apartments. And at the same time, we have to then look at our investors and lenders and communicate with them and show confidence and say that we have a plan, and be honest with them when things aren't working out, we need your help, because frankly, it's the lack of honesty that really will hurt the relationship in the long run. So we try to be upfront, honest, communicative, up and down the chain to whoever we're dealing with. And of course, that means seeing me and knowing that I have my hand on the pulse of what's going on, and that I'm going to backstop everything that we're doing.
Yeah, I think I would agree with everything that Pat and Norm are saying. What people need is they need to know that you've got their back and that you really care about them. And unfortunately, we've had people at the company that have gotten sick, gotten very sick. We've lost employees, unfortunately, and but you know, I'm on video with all of the employees every single week, assuring them, thanking them for everything that they're doing, and as Norm said, just giving them the comfort of knowing that we're there for them. And it's, you know, we're trying to keep it business as usual as much as we can, but really when people need help. And what's really interesting is that even our employees, like, you know, not everyone has a great domestic situation either. You know, people sometimes come to work to get away from their domestic situation, and being stuck in the apartment with a couple of kids and a spouse that doesn't quite get it can be pretty difficult. And we're doing everything we can to be helpful to those employees also.
The work trip, the business travel trip is going to take on a whole new meaning after this. People are going to be, I'll go.
I apologize. I have to end it because I was told we have a hard stop. So I wanted to make sure. I'm glad everybody got to put that input. Before I end, I just wanted to thank today's host, the Riverside family of companies, including The Experience, a real estate education and networking platform, Riverside Abstract, one of New York's largest title agencies, as well as Riverside 1031, a qualified 1031 exchange intermediary. I want to thank everybody, my whole panel. This was a very wide-ranging and fantastic chat, and I'm so honored to have been here with you today.
Oh, you did good. Thank you.
Thank you. Thank you.
Stay safe and sane, everyone.
Yeah. Norm, I'm stealing that line you said. I love that one. Thank you, guys.